if you find yourself with $12 million needing a place to put it, I'm your man. I'm your man. I'll tell everyone else to go to hell. All right, what is up, and welcome back to your favorite Tulsa-based commercial real estate investing podcast, How to Invest in Commercial Real Estate, and we are back.
What's up?
Here we are.
Brian's excited again.
I'm excited again. Let's do this.
Do you know how much it takes for me to work up that intro? Like, I turned it on, and then hey guys.
Yeah, what's up?
Hey, what's up? What's up, Braden?
All right, well, interesting show today because we have been saying we're waiting on stuff, and we're finally not waiting anymore. So I love that, right? But real estate's a game of hurry up and wait, so we're comfortable in that space. But we're done waiting on the closing of the Burleson learning experience. We have that equity raise fully funded, modeling super high returns on that deal. I think the IRR is
over 30.
Over 30.
Yeah.
Super excited about that. Another learning experience deal. Ideally, by the time we finish construction and get this thing out to market, we're in a significantly different economy where rates are lower and the 1031 exchange buyers are back. That in Burleson.
When do we close that?
We closed that today. So if you're seeing this, we closed it last week.
Yeah, nice.
Yeah, good.
Yeah. And then we have been talking about this gas station acquisition, the big sale leaseback. We are happy to report that is now in contract. It is now out to all of the investors on the investor list. You can find the link. I'm sure we can link can we link the thing in the video? Yeah. So the link is up here somewhere. It'll go to the website, find out tons of information there. And that is the show today. We're going to dive deep into our PetroMax 15 gas station acquisition sale leaseback, I'll call it. Man, that's a mouthful.
Yeah.
Yeah, it's a big deal. So we can dedicate the whole show to it, I think.
Yeah. So getting right in, we'll put some pictures up of the deal. We've got the pitch deck up. Why do we love this deal?
I love the deal because it's a way to get arbitrage on the purchase price by buying in bulk on a sale leaseback and then breaking it up and selling it to smaller individual 1031 buyers and getting a premium. Yeah. That's the value add on this deal.
Yeah, that's the basis of it. Right. So, Braden, what is a sale leaseback?
Great question. So a sale leaseback, and I think Joel may have defined it for us before we got on, so he'll probably have a more technical explanation. But really, it's when an owner operator of a business and building typically is trying to fuel growth and fund growth. So they sign a lease on their piece of real estate. They sell the piece of real estate for whatever the market value of that is, and then they take those proceeds and invest it back into the business to grow the business, which is why you see all of these businesses rent their real estate to begin with. But most businesses don't start out that way. Typically it's the 1, 2, 5 unit operator, whatever it is. They've owned and operated it for so long and they've been able to do that. But then they think of, okay, I make 20 or 30% margins selling gas and slushies. Why do I hold this real estate that maybe is worth a 7% coupon to somebody else? I could sell that and then just focus on what I'm good at, what I'm good at making money at.
And so essentially that's what this company that we're buying from wants to do, right? They want to get some more money so they can go out and buy more gas stations, essentially, right?
100% correct.
Yeah, okay. That makes sense.
Yeah, and it's very similar to the ground lease discussion that we had where you have these companies, they want to open more and more stores and they don't want to get bogged down by having all their capital tied up in land, which is not depreciable at all, or into real estate. They'd rather have that money driving their business growth. And so same thing with a sale leaseback. It doesn't have to be where the owner has a free and clear business. They may even have debt on it, but they don't have a rent payment. The rent payment is 100% depreciable. And so they're going to trade the cash flow of a rent payment for capital to go invest into new locations in this case. Yeah. And so also allows them to maximize the value of the income because he can then set that rent payment to as high of a point as he can to raise the most capital. And as long as the cash flow from the business can pay for that rent payment, then he maximizes the cash that's held in those buildings and he goes and buys more locations or leases more locations, let's say.
Okay, so we're buying 15 locations, all in Texas, right? Sort of Dallas,
Yep.
Houston, Austin, and surrounding areas, correct?
Yep.
Okay, and so once we put this deal together, what kind of numbers are we talking about? What's the raise? What's the cash on cash, IRR? What's the strategy here?
Yeah, so before we get into the quantitative numbers, the strategy, I mean, the very simple arbitrage is we're buying in bulk pricing in what I would consider not the most favorable economy, right? And we're getting a price that reflects that.
Yep. And
our arbitrage is by the time we start splitting these off and trying to sell them one by one for what we believe the value to be, we're going to be in a better environment.
Well, I would think that the fact that even if it's not a better environment, I think the fact that you're buying sort of in bulk and then piecing these out a few at a time,
100%.
people are going to buy the smaller quantities at a higher price, right? So,
Yep.
yeah, hopefully it's a better economy, but even if it's not, I think we're still in good shape.
Yeah, you're 100% correct. It doesn't have to be better, right? Texas is a tax-free state, and generally we're assuming we're going to sell one of these every 3 months. We're going to go out with several listing agents, 3 or 4. We've interviewed and vetted several, just getting our broker's opinion of value, having those conversations. Hey, Mr. Guy at whatever brokerage or girl, if we had this gas station, what would it be worth standalone? And we've been getting tons of those from a lot of different people because those are the data points of our indication of value. So that's really important. And generally speaking, big round numbers, we're buying it at a 9% cap on the NOI. That's, day one. We get the opportunity to write the lease. We already wrote it, negotiated it with the operator, absolute triple net lease. And we're going out and we'll probably put 3 or 4 on the market initially. And then as the brokers sell through the product, we'll give them more product. Obviously, we can't go out and put all 15 on the market at the same time. Kind of oversaturates it. But there was a point that you were getting into about setting the rent of these stores. And that's a really good point in kind of the management of the risk of this deal is how do we know how well these stores are performing? How do we know if they're performing at all? What if he's just selling us a bunch of, shitty gas stations? Well, that was one of the first questions we had is, hey, we need financial statements on the personal guarantee and the corporate guarantee. We need to understand this corporate structure. How many employees are there? How many other operations do you have running? What are you going to do with capital? So,
well, not only the overall financials picture, but the picture for the finances for each and individual property, right?
And that as well, right? To where we can go into each store and say, okay, this store is doing $5 million a year in sales. This store is doing $7 million a year in sales. This one's doing $4 million a year in sales. And we can set the rent for each store to get to a healthy occupancy cost for the operator. And that allows us to see which stores are killing it and which stores are doing okay, which stores are doing good. So, and we can set the rent accordingly, which is great.
I think it's also important to remind people, I think we probably said it on a previous show, but we went and looked at each and every of these 15 gas stations, right?
Yeah, that was vlog number 1. If you have not seen the vlog, be sure to go check that out. That was a fun one.
Yeah, that was a good one.
Yeah, riding around Texas in a Sprinter van.
Yeah.
Yeah, we didn't share, but when we were dropping off the Sprinter van, we definitely pulled into the airport and got stuck in between 2 pieces of concrete. That was fun. I'm pretty sure Aaron was in the bathroom when that happened.
Stuck on the clearance 7'6" sign, and we were higher than 7'6".
Yeah, something like that. All right, so then before what do you got next?
Yeah, so I was asked about the returns, and I kind of danced around it and didn't answer it. Over the 4-year investment horizon, we are targeting on selling one asset every 3 months until 4 years. Of those sales, 75% of the proceeds will go to pay down debt. 25% of the proceeds will be released to the limited partner, and the amortization schedule will be reset, allowing the cash on cash to actually increase over the whole time, which is really good. A point here because we're buying these assets and they're covering the debt well, right? We're going to pay out and meet the preferred return of 8% on the first year, assuming we sell nothing, which is a really good spot to be, I think.
Yeah, and then we're able to increase the cash on cash because we're going to be selling these for more than we paid for them.
Correct.
So we're paying the debt down more, and since the AM schedule is resetting, the cash on cash will go up as we sell locations.
Nice. Yep. So 48-month IRR is 23.5% with a 1.54 equity multiple. And again, what's driving that IRR is the distribution every 3 months. As we sell each one of these assets, the LP will get a return of capital by the 13th out of 15th sale. So by the 13th sale, all of the equity will be paid back. And then those last 2 sales is really where we bring in the gravy.
So someone may say, well, normally, guys, you're giving me a 2x multiple over 5 years. This is a 1.55 or 1.54 over the 4 years. The reason that is, guys, is because every time we sell a deal, we're giving you some of your capital back. And so the risk is going down, but it lowers the multiple because we don't have 100% of your capital for 4 years. If we did, your multiple would be higher.
Yeah, so that brings us just at a very high level conversation, the difference between a return, an equity multiple of like 54% over 4 years versus IRR, because IRR is focusing on the time value of money. So it focuses on the return of that dollar while that dollar is invested in the deal. So as soon as we start paying those dollars out, that reduces that and accelerates the return. Anyway, what else? I know there's some things on depreciation on the asset.
Well, we were
want to
going to
get
talk
into.
about what are the ways that we're reducing risk on this deal. So I don't know if you have some thoughts on that.
Okay, first of all, so what kind of guarantees do we have on the deal?
Yeah, so we have a personal guarantee of the owner of the operations company. The liquidity statement is, I think $30 million net worth, $30 to $50 million net worth. I think we're adding
50.
Yeah, I think it is 50 as well, edging on the side of caution. That number will obviously go up with the sale. I think we're looking at $10 million in liquidity being added after the sale, and then that should be shoveled back into the corporate structure to fuel new growth and new gas station developments. So we get both of those guarantees. And then again, we got the sales for each of these stores. So in our opinion, just the historic sales will be enough to cover the rent, assuming, we never have to go after that guarantee.
So you mentioned this before, and I think we should go into a little bit deeper. You said we're going to set the rent for each store. How do we go about doing that, and why is that important?
Yeah, so in the beginning, we were negotiating super big round numbers, as if we didn't know anything about the stores, because it's really hard to set an NOI and a rent for each store when you've owned it. You're not maybe paying yourself rent or as much, or maybe you're paying yourself too much to weight that loss or weight that entity with losses instead of the other one. So we negotiated a gross net operating income number for the entire 15 sites and negotiated a market cap rate on that number, which we believe to be a 9% cap.
Yeah, so I just got the income at about $4,050,000 if we put a 9 cap on the purchase price. So what you're talking about is that we look at each individual stores and we allocate a rent payment that's in line with the market and industry standards with the amount of sales that it has. And so that way, if you have a store that's doing really well, they'll have a higher rent payment, higher sale point. And if that's not, then we were able to reduce the rent for that purchase or that sale and make sure that it all aligns with the market. Right.
Okay. Yeah, that, and to be honest, there's some stores that do too well to where, we lowered their rent to lower the purchase price because, nobody wants to buy a $7 million gas station in Corsicana because the rent is so high because they're killing it. It's just like at the end of the day, it's $7 million gas station in Corsicana. So that's another benefit where, when we're acquiring 15 sites, we can set a healthy rent looking at the value of the capital markets on the back end.
Okay. And that rent's already been negotiated. That was part of the contract?
The gross rent for all 15 sites has been negotiated. We've got 30 or 45 days once we're in contract to come to an agreement with the seller on those numbers, and the discussions are happening right now. We're going through the sales, and I think we've made our first pass, and it's in their court now to just kind of
and to further mitigate risk. I assume these are going to be triple net leases.
That's another great question. So moreover, they are absolute triple net leases, which means the tenant is paying their own property taxes. The tenant is self-insuring their building, and the tenant is not only paying for it, but facilitating their own common area maintenance. So
there's no responsibilities for us on an absolute triple net lease.
Okay. Yeah.
Which again, we're doing that purposely for the value of the investor on the back end, right? The cleaner and easier we can make this, the better it's going to be. And we were proactively reaching out to brokers who are selling this type of asset class to help us with that lease. Hey, Mr. Broker, you sold $50 million or 100 gas stations. Yeah. I need a good sale leaseback gas station lease that you can sell. You're in this space, right? So that's what we're doing. And I know we preach this shit all the time on the podcast that you should be doing that, but there's a real world example of we have to get indicators of value. So we called a lot of people and we're talking to them. Hey, you do this all the time. Yeah. And I think people are scared to ask, hey, do you have a lease? Like everyone's going to call their attorney and pay them $20,000 to get some half-ass lease from an attorney that probably doesn't specialize in retail leases. Or you could just texted your buddy or me and said, hey, can I see your lease? Yeah. I probably would have been like, yeah.
Brand new 15-year.
Brand new 15-year.
Yearly increases?
Yearly increases. I think they have 3 options, 3 5-year options, which, are what they are.
Okay. And then what are some other benefits? One, we already mentioned the tax-free state.
Yep.
But also gas stations come with a unique depreciation schedule. 60%, you can depreciate the building 60% in year one.
Yeah, so just with the current 179 bonus depreciation, we're at 60% in 2024 now, assuming nothing changes. Right now, there's a lot of discussion and talk, and I think it's already passed
The House, I think.
the House to bring bonus depreciation back up to 100% for gas stations in specific, and they may vary by asset class. But yeah, assuming nothing changes and it doesn't get passed in the Senate, we'll have a 60% bonus 179 depreciation that we'll be able to take this year, which is huge, right?
And it's something to offer buyers as well.
Which means what? You can depreciate 60% of the value of the property, minus the land.
Yeah.
In the first year, and then the rest of the building is flatlined over the remaining 30
And do gas
years.
stations versus retail shopping center like we do, are you able to, on the cost segregation, are there any advantages to gas stations?
Yeah, just because inherently they have more working components and equipment specifically related to the sales of gasoline. So they allow you to separate those out from the actual building and depreciate them faster. Okay. Because it really is, like if you bought a lot of these working components separately and didn't attach them to a building, you'd just be able to depreciate them as equipment significantly faster. So the IRS is cognizant of that in the code.
Okay.
So yeah, that's a value for us while we're holding it. We're going to enjoy those write-offs. Heck yeah, sweet. And then the buyer of these assets, again, I've made this correlation several times off the show, but we hear of people, crazy wealthy people buying like a G550 or a Gulfstream or whatever for like $40 million for a tax write-off. It's, their end of year truck, just at a different scale. This, in my opinion, especially if bonus depreciation gets reset up to 100%, this is a Gulfstream with a 7.25% bond coupon attached to it, right? You write off the whole freaking thing that year. You don't have to buy the Gulfstream. You don't have to pay for the Gulfstream. And in fact, the Gulfstream now pays you 7% of what you paid for it. Yeah. That doesn't exist. Yeah. It's not a time machine like a Gulfstream, but taxes definitely helps. Yeah.
So that's a lot of benefits. I don't have any more written down myself.
And a couple of the things we did to make sure that we're eliminating as much risk as possible. Getting brand new surveys on all 15. We're getting brand new property condition reports to make sure that the buildings are in good shape, right. Roof, structure, parking lot. Right. What else? We're getting phase ones on all of them. Obviously, they're gas stations, so we just there is issues there, but hopefully we're doing everything we can to mitigate the risk on these sites.
So
brand new surveys.
So we said we're going to our plan or strategy is or what we modeled was 1 unit every 3 months. I assume as soon as we close and we're ready, we're going to pick 2 or 3 of these to put on the market just as quick as we can.
Yeah, I mean,
no reason to hang on to them longer than we want, right? I mean,
between us and our secret group of followers, I've already picked, who's going to sell these for. I've had calls with a lot of people. I know who I like. I know who I don't like. And there's some people I'm not going to call back. I'll tell you that. And there's some people that I definitely want to call back. And it's just the warm referrals we get. We work with a lot of brokers in the space, and there's just people who are better at their jobs. But yeah, we've picked 3 or 4 people. We haven't exactly told them. We've been having conversations with them. And yeah, we're going to pick 3 or 4, immediately put them on the market. As each broker will get 1. As the broker sells through the product or gets it in contract, that broker will get more product, right?
Some brokers will do better than others.
Yeah. And it takes the favoritism out of it for us, for the investors, for everyone else. Like, I want them sold. Yeah. I want anybody who can sell them to come and sell them. I want anybody who wants to buy them to come and buy them. I'm agnostic about it. I'm acknowledging that's not my shtick and not the value I'm adding. And there's tons of industry experts who can do that for us.
Well, it's a good way to figure out which brokers are motivated or able to sell them. And if 2 or 3 do better than the other 1 or 2, then that's who we'll stick with. I'm sure.
Yeah, just give 3 brokers, 1 or 2 each. Yeah. And the quicker you sell those, you get the next ones. I mean, it just creates that competition. Yeah. Well, okay, so all of this has been pretty positive, but there's one thing that may be a negative for some of the people that are listening, because not everybody gets to invest in this deal because we're doing a little bit different offering.
Yeah, always raining on the parade, man. Yeah, so. It is what it is, but according to the crowdfunding laws and the SEC, when we advertise or generally solicit a deal and talk about it and try to raise money from people we don't know and don't have an intimate relationship with already because they don't listen to our awesome podcast like you guys do, we can only take accredited investors. So typically we get around that because we're only launching them to our intimate group of investors, people on our investor list. This one, we're going to be advertising on Facebook. We're going to be hiring equity brokers. We're going to be launching it to our initial list. We're going to be partnering with anybody and everybody we can because we need to raise like $12 million hairs. Now, I know I said all that. If you find yourself with $12 million needing a place to put it, I'm your man. I'm your man. I'll tell everyone else to go to hell.
Yep.
Done. I'm your man. But yeah, accredited only. You're allowed to self accredit that, right? You're allowed to just say I'm accredited, and I can say sweet. This time we have to have a letter from your CPA or attorney verifying that
For everybody?
everybody. Yeah, everybody.
Even I have to get a letter from my attorney?
You're exempt because you're a principal of the offering.
That's the only reason, huh?
Yeah.
Everybody else got to have a letter.
Everyone else is not exempt and they have to get a letter. The good news is I can keep that letter on file for the whole year, and we're going to be doing a lot more of these. So
A lot of these people might already have that letter because they've done it before.
but it was for a previous year. So we're going to need a new one.
Oh.
But there's cool websites that it's like verifyinvestor.com. It's like $10, if you don't have a good relationship with your CPA or attorney, because most of the time CPAs and attorneys suck.
And you sign up and they can provide you the documentation that we need.
Yeah, you provide
Online?
them your tax returns proving that you're not poor, and then they send us a letter that says you're not poor, and then we can take your money.
So everyone that's not an accredited investor, you're saying is poor, Braden?
No, I just I don't know, man. I'm trying to make it more interesting.
Doesn't
All
like
right, I think
attorney-
we've gone long enough on this. Hopefully you guys are excited about this deal. It's our biggest deal to date.
Woo!
by far.
And we
By
think it's going
far.
to be a great opportunity.
Hey, it's the biggest deal to date because we're going to buy another one bigger.
Just to date.
Yep.
All right, guys, we'll see you next week on How to Invest in CREs.
Thanks.